At Ground Truth, we take a famous money strategy and test whether it actually works, on real data, with real costs. Today's subject is a retired prop trader. For 15 years, he traded a firm's own money, and by his own account, he made over $100 million doing it. When he retired, he sold everything he knows in one course, so we bought all of it. Not a summary, not the highlights, the whole thing. 121 videos and 13 PDFs, mined down to 1,080 rules, everyone tagged to his own words. Then we ran them. All of them. It took 2.5 months and every instrument we own, and the whole time we were hunting for one thing, the edge. 3 questions before we start. 1. If you code every rule a $100 million trader teaches, exactly as taught, does the machine make money? 2. When it doesn't, is that because the edge was never real, or because it lives somewhere the rules can't reach? 3. Can we find that somewhere and weigh it? Keep those. This is Ground Truth. And this is the audit of the whole course. Quick contract before the first pitch. This is education and entertainment, not advice. We test ideas, we don't tell you what to do. And the first idea is already at the door. With a shopping cart. Forget reverse engineering free videos, this is the real thing. A prop firm legend, 15 years on a desk, the firm's record year. He retired and put the whole playbook in a course. You're not guessing what he does, he tells you. You want an edge? You buy the edge. And here's the uncomfortable part. As pitches go, this one is strong. We vetted him the way we'd vet a market wizard. We checked, and it holds. Real desk, real tenure, real reputation. His specialty matters, too. He's a short seller, a trader who bets that stock prices will fall. More specifically, he's a mean-reversion short seller. He bets that when a stock has stretched too far, too fast, it snaps back to earth. On this channel, that counts as a character reference, and his course is the opposite of a highlight reel. It's dense, it cites his own losing trades, and it spends a full module on why most traders fail. His answer, in his words, they lack edge, and they're being fooled by the randomness of the market. So this is the strongest version of the dream on record here. The question is no longer whether a robot can copy a guru off free videos. It's sharper than that. If you hand a machine the complete, honest, paid teaching of a genuinely great trader, does the edge come out the other side? To run that test yourself, you'd need the course, months of build time, a database that still remembers every stock that went to zero, and a robot that never gets tired of losing. We ran it for you so that the tuition for this lesson comes out of our ledger, not yours. One more thing. Somewhere on the bench, there's a small scale. Ignore it, we'll need it later. Step 1. No paraphrasing. We transcribed the teaching and mined it into individual rules, 1,080 of them, each one tagged to the exact lines where he says it, and his framework survives the trip intact. Everything hangs off one idea he calls the right side of the V. The same price can be a terrible trade before the turn confirms, and a great one after. Why? Because what matters isn't price, it's expected value. Expected value just means what a bet is worth before you take it. And one honest disclosure, because it decides everything downstream. On his most important setups, the course gives you the doctrine, what to look for, and why it works, and deliberately does not give you numbers. How far above the moving average, the smoothed line of a stock's recent prices, is far? He doesn't say. He says it's a read. The map marks the region, it doesn't draw the trail. Remember that. 2.5 months of homework. Now, the part the homework can't help with. Strategy 1 is his signature. The exhaustion short, a stock that's gone parabolic, a near vertical climb for days, gaps up one last time, exhausted, and snaps back. We rebuilt it rule by rule from the course, and then we marched it through the gauntlet. First, the survivorship gate, a database that still remembers the dead stocks so the winners can't grade themselves. Then the friction grinder, real costs, real fills, years of data. And the first printout came back, up $33,000. There it is, print the thumbnail, we're rich. Then we asked the boring question that kills most strategies in this lab. Where did the money come from? One ticker, AMBQ, was 75.8% of the entire profit. That's not an edge. That's a lottery ticket wearing a lab coat. Take away the lottery ticket and run his exits as taught, and the strategy loses between $57,000 and $69,000. So we tried to save it. We invented 4 mechanical exit rules of our own, sell rules a machine can follow with no judgment, and gave the strategy every chance. The kindest one still lost $47,600. Strategy 2 was the full composite, everything the course states outright, wired into one bot, his own risk vetoes included. That one took months to build, and it gave the same answer at every honest test we ran, so we shelved it, no edge. 2 strategies, 2 clean funerals, and that was the good news. Because strategy 3 is where our own instruments turned on us. The news short, the most machine-friendly thing he teaches. A company announces a share offering, printing new shares, shrinking every existing slice. The stock drops. You short the headline. It has everything a machine loves: a discrete event, a defined stop, the preset price where you admit you're wrong and get out, and a mechanical trail to ride the move down. We pre-registered the test, wrote the pass bar down before running it. The early runs used the wrong trading session and came back dead. Then we ran it in the session he actually trades pre-market before the opening bell. And the result came back positive. It cleared the bar we'd written down. It held when we removed any single name. For a few hours, on one June morning, this was the first positive edge transfer in the history of this laboratory. A few hours? What happens in a few hours? Our own safety gate went off. Listen closely. What happens next is the part worth keeping. The test needed to know which stocks were safe to bet against. Safe means big, heavy names, and big is measured by market cap, the total price tag on the whole company. Small stocks are the dangerous ones, because small stocks can get squeezed. Panicked short sellers all forced to buy back at once, rocketing the price. So, the filter sorted every stock by size, and it checked that size using today's data. Not the size they were on the day of the trade, the size they are now. That is called a lookahead, grading yesterday's bet with tomorrow's answer key. Some of those safe, big names were tiny back then, exactly the stocks the rules say to avoid. The filter had quietly sorted winners into the test after the fact. So we reran it with point-in-time data, the world as it looked that day, no answer key, at 4 times the sample size. The edge measured basically 0. And a leave one out check, take out any single lucky name, pushed it negative. So we stamped it, retracted, and we didn't shred it. It went in the drawer where we keep our own mistakes, because a lab that only files its wins is running the same game we audit. We could have shipped the pretty version, you would never have known. This is why the bar gets written down before the test runs. The pre-registration wasn't protecting us from him, it was protecting you from us. We kept testing the honest version, including his bankruptcy headline variant, across 120 companies announcing they were headed for bankruptcy, including the ones that survived. Same shape, the crash is real, but it lives in stocks too small to borrow. To bet against a stock, you first have to borrow its shares, and for these, nobody lends them. And in the big, liquid names, the ones you can actually trade in size, the drop reverts. The layup, at machine speed, does not exist. Halfway, 2.5 months in, 1,080 rules, 3 strategies tested, net, deep red. And the questions have not moved. 1. If you code every rule a $100 million trader teaches, exactly as taught, does the machine make money? 2. When it doesn't, is that because the edge was never real, or because it lives somewhere the rules can't reach? 3. Can we find that somewhere and weigh it? 1 contestant left on question 1. Strategy 4, the last one. We stopped writing rules altogether and sat an AI in the pilot's chair, gave it the doctrine, and let it try to be the discretionary trader. It failed its capability test before it ever earned the right to touch money. That experiment deserves its own video. 4 strategies. 4 funerals. Question 1 answered. Here's where a normal autopsy would stop and declare the whole thing fake. We didn't, because the course kept telling us where to look. Every number it refuses to give, how far is too far, when to override the stop, where the real exit is a hole with a shape. If his edge is real, it has to live in exactly those holes. That brings us to question 2. We bait 2 instruments to measure the holes themselves. In mining terms, we'd proven the rocks aren't gold. Now we assay the dirt, we weigh what's actually in it. Instrument 1, we call it the clairvoyant ceiling. Take the machine's 91 signature short entries. Ask, if you exited perfectly, sold on the exact best day, every time, knowing the future, how much money is buried in these trades? And the control, run the identical perfect exit test on random days in the same stocks. If the course's entries are just noise, the 2 piles should match. They don't match. The entries picked by his rules carry extra, real follow-through that random days simply don't have, roughly 2.4% per trade. In lab units, that's 238 basis points, and a basis point is 1/100 of 1%. The odds of that being chance, about 3 in 10,000. And here is the twist the 4 funerals were hiding. The course's eye for a dying stock is real. It's in the data. We measured it. So the course works. Buy the course. Mine the gold. Weigh the gold first. With a crystal ball, perfect exits every time, These 91 trades make plus $87,000. The best real exit rule loses $47,000. So, to just break even, a real exit engine would have to capture about 35 cents of every crystal ball dollar. Before this test, we would have generously guessed a machine captures 25 cents of that dollar. And every time this lab has actually measured a machine converting expert judgment into money, the answer has come back in single-digit basis points. Crumbs. It needs 35 cents on the dollar. It picks up crumbs. Instrument 2 exists because maybe the edge isn't in the exits at all. Maybe it's in the eye, knowing which charts to pick, and if this one clears the bar, everything you just watched gets overturned. We took 756 candidate setups, stripped the names off, and had an AI grade the raw charts strictly by the course's own doctrine, blind. Then we checked the grades against what actually happened next. The result, a real whisper. The doctrine's grades do rank outcomes better than chance, and better than the simple mechanical yardstick we ran beside them, but now look at the size of it. The gap between the best graded quarter and the worst graded quarter is 78 basis points. The bar we wrote down before grading was 200, and these are trades that routinely swing 1,000 basis points either way. The signal is real. The noise is 13 times louder. We have a name for this now. The ore grade problem. The ore grade, how much gold you get per ton of rock you crush, decides whether a mine is worth digging. The gold here is real. The assay proves it. And the grade is too lean for any machine we own to mine. Write it on the wall, next to the violinist problem. So, question 2, answered. The edge is not dead, it's unreachable. What the course teaches transfers completely, the doctrine, the setups, the risk rules. We verified that line by line. What made him rich is a different story. The thresholds he calls a read, the override he calls a feel, the tape he watches at a resolution our bars can't see. None of that transfers. But we measured the shadow that judgment layer casts on the data, 238 basis points of it, and a machine cannot pick it up. And here's the part that reframes the whole autopsy. He told us. In Module 3 of the course we bought, his own list of edges names the experience, the discipline, the intuition, and says those, quote, can't so easily be programmed into an algorithm. We spent 2.5 months and every instrument we own trying to prove that sentence wrong. We proved it right. The man sold us a map, marked the one region, here be judgment, and that is exactly where the treasure was. So, the course is a scam? No. And it's worth being precise here, because the precise answer is the useful one. Nothing we measured contradicts his record. The record is his to report. And our instruments found that entries picked by his rules really do carry follow-through the market pays. What we measured is narrower and more useful, what you are buying. A course like this can teach you what a great trader believes, faithfully. What it cannot do is hand you his edge, because the load-bearing part is not made of rules. It can't hand the edge to a machine, we measured that. And it can't hand it to you at course speed, because the part that isn't words is paid for in screen years. Your robot will execute the syllabus perfectly. The syllabus was never the edge. 1,080 rules, 0 edge, and the edge is real, a machine just can't lift it. Why do smart people expect otherwise? 1. The syllabus is visible, and the judgment is invisible, so the visible part gets the credit. 2. Every seller of every course, honest or not, benefits from that confusion, so correcting it is nobody's job. The rare exception is on the syllabus you just watched. Module 3 flags the part you can't buy. Almost nobody reads that page. And 3, by the time you've paid tuition and can't find the edge, you blame your own discipline. His own module says exactly that. Traders getting fooled by randomness, grading themselves on streaks. The mechanism that sells bad courses is the same one that oversells honest ones. So what am I supposed to do with all this? Funny you should ask, because something in that cart did transfer, completely. Not a trade, a discipline. His rule that the true stop is where the expected value of the trade touches 0. His habit of testing a batch of trades and judging the pile, not the single trade. His insistence that you are never trading prices, you're trading expected value, re-estimated bar by bar. We didn't put those in a bot. We put them in the lab. That is literally how the tests you just watched are run. The one thing in the course a machine could fully inherit is the way he thinks about testing. So if you're ever holding a checkout page, his or anyone's, here's the portable version of tonight, you are buying the syllabus. Ask what the syllabus is worth on its own, because the edge is not on that page. And anyone who tells you it is selling the part that can't be shipped. Question 3. Answered. We found it, and we weighed it. The scale is on record. So what would change our mind? The instruments are frozen and rerunnable. The clairvoyant ceiling, the blind grading harness, all of it. And we published the bar. The day a machine captures 35% of that buried value, this verdict flips, and you will hear it here first. We rerun the assay on every new generation of AI. So far, the OR wins. This is ground truth. Final ticker, 2.5 months. 1,080 rules. 4 strategies, 4 funerals. 2 instruments, and 1 real edge. 238 basis points, sitting right there in the dirt, too lean for any machine we own. We bought the whole course so you'd know exactly what's inside. A real teacher, a real edge, and the measured reason you can't buy it. The map was honest, the gold was real, the grade was too lean. If there's a course you want on the scale, comments. The machine is always hungry.